We start off with today's big market sell-off. Stocks tumbling after Fed Chair Jerome Powell said the path forward is highly uncertain and subject to many downside risks.
A prolonged recession and weak recovery could also discourage business investment and expansion, further limiting the resurgence of jobs as well as the growth of the capital stock and the pace of technological advancement. The result could be an extended period of low productivity growth and stagnant incomes.
And then there's this, Stanley Druckenmiller telling the Economic Club of New York that the risk reward for equities may be as bad as he's ever seen. And David Tepper of Appaloosa telling Scott Wapner today that this is, quote, maybe the second most overvalued market he has ever experienced. So did the markets just get a big dose of reality? Guy.
First of all, I know you're not in charge of music here on CNBC's Fast Money, but I will tell you, and I'm getting ready for the Twitter hatred, but Danger Zone by Kenny Rogers is up there.
And we're going to play it over and over again.
Loggins, not Rogers.
Yeah,
Loggins,
it's not Rogers.
Doesn't matter. I mean, you know.
Loggins.
My point is, it's an awful song. Loggins and Messina, I'll take, but Kenny Loggins, awful.
Come on, man.
With that said, you know, there are a lot of people that bow at the feet of David Tepper for good reasons. But those same people then today say, well, you know, maybe we shouldn't listen to David. If you liked him when he was bullish, you got to respect him when he's saying this is one of the most overvalued markets he's seen in his career. And that on top of what Stan Druckenmiller said, you know, absolutely has to give you reason for concern. And kudos for Dan Nathan, who will fricassee me at some point of the show, for pointing out the horrible performance of the banks while this market's been going higher. The good thing about today, if there is a good thing, is that the S&P traded smack down to 2790, held and bounced 30 handles into the close. I'll take that as a ray of sunshine, but you doused it with that awful choice of music.
I actually called for that specific song, Guy, knowing that you hated it. Dan Nathan, fricassee now or later?
Yeah, well, listen, you know, Guy mentioned that technical level, 2790. I think what's really interesting about that is that in the S&P 500, that is almost exactly the midpoint of the range from the February highs to the March lows. It's also a level where we were a month ago, and it's also a level where we were a year ago. So the market has made very little progress over a longer period of time, and right now it's taking a little time to digest a little bit. Listen, I want to be very clear. I think every single one of us panelists in late March, probably to the day, whether it be the 23rd or the 24th, we're saying that 35% peak to trough decline was overdone. We expected a bear market rally in the range of 20%. We got to 35%. That might be commensurate with the sort of fiscal and monetary response that we got in such a short period of time. But now investors have to make a decision. I think listening to some of these guys like Tepper and Druckenmiller, who is one of the smartest investors of the last 3 decades, makes a lot of sense to listen to a little bit about their history with the markets, their history with valuation, their history with crisis. To me, I think you want to be listening to those voices right now, especially when the market is at a very critical technical level.
I mean, Jerome Powell today, Tim, and I know you hang on, just like many market participants, hang on his every word. He also indicated that his worst case scenario is a period of low productivity growth and prolonged slow growth in income, which is not a good sign for the economy, not a good sign for the stock market. And he also said that we need fiscal stimulus, which almost sounds like, you know, that Fed backstop is limited in what it can do. Again, and we've hit this over and over again, this is not just a liquidity problem. It is right now, but it could be a solvency problem, which the Fed can't necessarily solve.
No, they can't. And that's the problem ultimately with negative interest rates, too. So I'll save that for a later part of the show. But the Fed can't solve companies who have no EBITDA. And ultimately, you're going to get into a situation where it will be untenable. Look, Fed's Powell today was realistic at best. But on the downside, he really pointed to an economy that will need more help, and that all they have done here is to try to, you know, throw a lifeboat to liquidity. And that's really all they should be doing. So today was a concern, and it was a concern because I think you really had converging thoughts. Okay, we just talked about market players, but how about the U.S.-China rhetoric? Guy's done a nice job of bringing this up. If anything, I thought it was ratcheted up today when they essentially said, and through the mouthpiece that often is the Chinese government, that there'll be consequences for states or individuals or companies that attempt to extract some kind of litigation or something against the Chinese for COVID-19. So I think we had a handful of things after a 6-day run in the markets before yesterday, where obviously the tide turned and the technicals broke down, which is why it's great we have Carter here today to talk about those charts.
The gremlins have gone for now, so Karen is with us. Karen, what'd you make of today's action, and especially in light of your final trade yesterday, which was mimed effectively when you crossed your arms? And I do think mime may be really underutilized in this format of television. But you crossed your arms, indicating you're going to stand pat.
It's a stand pat, do nothing, right? I think that, obviously the run has been enormous. So we all know that. Dan, talked about the magnitude of the bounce back. So that's the number one thing. And then I think that, we haven't had a good look at all at how openings are going. How is it going to be to get this economy back on track? How slow is it going to start out? And how long will it take to actually get some real momentum and get a sense of how long it'll take? I feel like we have no data yet on that, yet the market seems to have priced, even with this 2-day sell-off, seems to have priced things going pretty well in terms of people going out to eat again. Restaurants have been doing well. There's some hope for some retailers. So I think that ultimately we will get there, but I don't know how easy it's going to be. This rally the last 6 weeks made it look like no problem. It's going to be really easy. All that having been said, though, I'm long. I'm always long. So in a market like this, I really am not sure what to do except for wait for things to come my way or put on some hedges when they get too frothy. And so I do have some hedges on. I'm short some triple Qs, but I'm absolutely long. Google's my biggest position, Facebook, Apple. So I have exposure there. I have definitely exposure in the banks. I'm short some HYG. That's not really working right now. So again, I'm a little stuck about what to do because I think that the Fed has given us a life raft for some amount of time.
Right.
I don't know how long that is.
Right. We don't know how long it'll stay inflated, the raft that is. Speaking of banks, though, Tim, we have been commenting for some
good
time.
Metaphor.
For some time that they trade horribly. Dan, in particular, bringing up the most important chart of the world in JP Morgan, but you actually have another chart.
Yeah, look at Wells Fargo. And so while we know that banks are making new lows relative to the S&P, and that is scary, and that speaks to yield curve, negative interest rates, credit issues, Wells Fargo is a bigger concern because this is one of the top 4 money center banks in the country. We know Wells Fargo's issues and some of their compliance regulatory things that have run afoul, and certainly customer loyalty questions. But the way the stock's trading, if you look at this chart, first of all, it's underperformed the XLF by 37% in 92 sessions. Okay, that's implying that there's something greater going on. And I'll just say that Wells Fargo, on both valuation and on its relative performance to the sector, looks untenable here. And in fact, there are a lot of conversations, as people remember what went on back in the crisis of 2008 and 2009, forced marriages, people that were forced to get together. I don't think we're at that stage here, but it's very clear. It's very clear Wells Fargo is a wicked underperformer relative to its peers, and that's after 3 years of underperforming, and it has me concerned.